The US stock market has been melting up, printing over a 20% gain within just the last 6 weeks, officially making this the most powerful rally since 2020. Zooming all the way out to the 1960s, we've seen this type of powerful rally only occur a handful of times throughout history, and typically it's marked large bottoms in stocks that have been in almost all cases followed by very strong multi-year stock market rallies. At the same time, a record 48% of US consumers believe that the stock market will be heading lower over the next 6 months. These concerns stem all the way from a possible recession, inflation risks from tariffs, the risk of a government debt crisis, the possibility of the US dollar collapsing, and yet despite all of this, the stock market has been able to thrive. So we're going to look at exactly why stocks are performing so well right now and evaluate whether we can expect this strong performance to keep on going despite all of these risks. There are 3 big things happening right now that are pushing stocks higher. The most obvious one is that uncertainty around the trade war is cooling down. The level of uncertainty around US trade policy reached some pretty absurd levels just a few weeks ago. This spike that you see here was one of the big factors that drove the decline in the stock market. And this is one of the key reasons why we actually stayed quite constructive during this market correction, because as uncertainty declines, you basically get the mirror image of what you had when uncertainty rose. As markets are now seeing trade negotiations going in the right direction, this is exactly what's happening and explains why the stock market has risen so aggressively, because we're indeed just seeing the mirror image of what we had on the way down. Now, the stock market is actually back above where it was on April 2nd when Donald Trump's tariffs were announced. So pretty much all of the uncertainty around tariffs has been completely cleared up, which probably means that the pace of this rally is going to be at the very least slowing down from here. In fact, we even happen to think that the stock market is a little bit overextended here and could be due for a short-term pullback. So that's the first big reason uncertainty has cleared up. But this is basically just a one-off. Any additional upside in the stock market needs to be a result of other more durable fundamental forces that can push the stock market higher. And that leads us to the second big thing that's happening right now. Corporate America is thriving. The earnings of the largest 8 companies in the S&P 500 have been going through the roof recently. In 2025 alone, these companies have managed to grow their earnings per share by quite a bit. This is despite the 20% decline in the stock market due to all of the uncertainty around trade. So underneath the surface, corporate America has been steadily growing. Keep in mind that the earnings of just these companies that I've highlighted here make up 25% of the entire S&P 500 index. So these strong earnings do have a significant influence on the overall stock market. We've been long on Meta at bravosresearch.com. We're up over 12% just on this trade alone because the stock is basically just catching up to the reality of the earnings. Now, the question is whether these earnings can continue to grow over the coming year, and we happen to think that that is plausible. You may have seen one of our recent videos focused on the semiconductor sector, where we highlight why we think these companies could continue thriving over the coming months and years. Now, by the way, the performance of corporate America has absolutely nothing to do with the real economy. We can see that by looking at the performance of consumer-related stocks relative to the S&P 500. These have underperformed by over 23% since 2021. Small capitalization companies have underperformed the S&P 500 by 33%. This is the real economy, and it has not been thriving. Meanwhile, the technology sector has outperformed by 13% over the same time period, and the semiconductor sector has outperformed by 37%. And these stocks have once again been leading the entire market higher just over this most recent leg up. The sad truth is that this divergence could very much keep on going over the next few months, over the coming years. And overall, that would be a constructive thing for the stock market, and is one of the reasons why we've stayed very positive about where the stock market could go in 2025. So that's the second reason, and could be one of the things that continues pushing stocks higher over the coming months. But we do have one final thing that's happening right now that's playing a large part in today's stock market rally, and that is that the odds of a recession are going down. Betting markets following the Liberation Day announcement on April 2nd put the odds of a recession happening in the United States in 2025 at almost 70%. Today, those odds have come back down below 40%, and no, a recession has not been triggered yet. The absence of a recession means that the economy will continue to grow. This is something that a lot of people do not understand about how financial markets and the economy works. This is why over the long run, the S&P 500 goes up, because most of the time, the economy is steadily growing, which does mean our bias on the stock market should be to the upside. So does that mean that we should be going all into the S&P 500 right now? The answer is a little bit more complicated than that. One of our big principles at Bravos Research is that we invest when volatility is high and we trade when volatility is low. This is the volatility index of the S&P 500, and it recently spiked to the highest level since 2020, and before that, the great financial crisis. These are moments where we should be investing for the long run. So in early April, we were telling our members that that was an ideal moment to put capital at work for the long run in the stock market. But these kinds of high volatility environments where the VIX is above 30 are extremely dangerous to trade in because you have very wild swings that can whipsaw you in and out of your positions. Our ideal environment to trade in is when the VIX is below 20. This is where the stock market is extremely steady and where you're much less likely to get whipsawed out of your positions. So we have very quickly gone from an environment where we should invest back to an environment where we're going to be initiating a lot of trades. We've already had very successful trades on NRG, Meta, Costco, ADMA, SFM, and many more during this correction, but we're now potentially getting into an environment where we're going to be able to initiate a lot more trades than that.